In today's video, we will learn what is depreciation and how to calculate the amount of depreciation and to prepare a machinery account or a fixed asset account according to two methods, straight line method and WDP method. First, let us understand what is meant by depreciation. So, whenever we use an asset, the value of that reduces or decreases with the passage of time. Now, it happened due to various reasons, such as wear and tear due to its use in business, efflux of time, obsolescence due to technological or other changes, and so on. Now, depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. The depreciable amount of an asset is the cost of an asset or any other amount substituted for cost, less its residual value. The useful life of an asset is the period over which an asset is expected to be available for use by an entity or the number of production or similar units expected to be obtained from the asset by the entity. Now, why we calculate depreciation? It is to ascertain the true results of operations, then to present fair and true view of the financial position, to accumulate funds for the replacement of assets, to a certain true cost of production. Now there are certain factors which affect the amount of the depreciation. So it is the cost of an asset, the useful life, the estimated useful life or expected, and its estimated residual value. That means the amount of the asset that will be there after the useful life. There are two methods of calculating depreciation. It is straight line method and diminishing method. So as it is said, results in a constant change over the useful life if the residual value of the asset does not change. So charging the same amount of depreciation every year is the straight line method. Whereas when we charge depreciation on the decreasing method, like results in a decreasing charge, so basically we charge the depreciation for a particular year and then reduce the value of assets with that, and the amount that is remaining after the end of that year, we charge depreciation on that amount. That is basically charging depreciation on the written down value. So straight line method, the formula is that take the value of asset less scrap value. The scrap value is nothing but the residual value after the end of the useful life divided by total useful life. And to calculate the rate of depreciation, we can do the amount of depreciation divided by the cost of asset into 100. Let us understand with the help of a sum. Now, Jain Brothers acquired a machine on 1st July 2021 at a cost of 14 lakhs, and it has also spent 1 lakh on its installation. So we have already studied that any amount that is spent on the installation of a machine freshly acquired, we capitalize that amount. So here the value of machine will become 15 lakh. Now the firm writes off depreciation at the rate of 10% of the original cost. So it is basically a straight line method. So let us prepare a machinery account. So while preparing machinery account, we will pass the entries. So it is date, particulars, amount, and again date, particulars, amount. And there is a journal folio column also because it is a ledger account. So we acquired a machine on 1st July. So on 1st July, we'll pass the entry as to bank account 15 lakh. So it is basically cost plus installation charges. Now we'll give the depreciation. Now it is said that the books are closed on 31st December. So on every 31st December, that is the last day of the year, we need to pass the depreciation entry. So it is by depreciation account. Now calculating depreciation. How we will calculate depreciation? So depreciation, as we have already studied the formula, it is cost of the asset less any residual value divided by number of years, that is basically useful life. But here we have already been given the rate of depreciation. So instead of applying this formula, we can calculate the depreciation as depreciation is equals to cost of the asset, that is 15 lakh into 10%, that is 1,50,000. Now this is per annum, like it is charged for a particular year. Now we have acquired the machine on 1st July. So the accounting year is from January to December. We have purchased the machine after 6 months. So we will charge depreciation for only 6 months. So half of this, that is 75,000. Now we can just balance it. Now this will become the opening balance in the next year. Now we will again pass depreciation for the next year. Now in the next year, we'll charge depreciation for the full year, that is 1,50,000. Since it is a straight line method, every year the amount of depreciation charged will be same. So again we can just balance it. So we'll get this and just close the account. Similarly, in the same sum, if it has not been written as original cost, instead it has been written that the firm writes of depreciation at the rate of 10%, and we need to calculate the depreciation with the help of written down value method or diminishing balance method. In that case, the depreciation for the first year would have been depreciation for 2021 would have been 1,50,000 into 10% for 6 months only. So for first year it had been 75,000. Then what was the value remaining? So the balance of machine at end of 2021 was basically 15 lakh minus 75,000, that is 14 lakh 25,000. Now for 2022 depreciation, for 2022 we would have charged a depreciation on this diminishing value, like on 14 lakh 25,000. So it is 1,42,500. So in case of diminishing method or written down value method, we need to charge depreciation on the balance amount at the end of each year. Okay, thank you.